Hi fellow traders, welcome to the first session of the inaugural Online Trading Summit, possibly Asia's first virtual trading conference. My name is Philip Teo and I'm the organizer and your host for this summit. Besides taking on this ad hoc role over the past few months, I'm also the founder and CEO of TraderWave.com, a next generation web-based charting application that helps global traders track and be alerted to important trading opportunities based on their technical trading strategies. Educating retail traders is also something that I do as a partner trading coach with SGX Academy. Prior to that, I was the Chief Technical Analyst for a Singapore-based investment research firm for more than 8 years. Now that you know more about me, you might be wondering how this idea of organizing an online trading summit came about. Personally, I've attended and spoken at numerous offline trading conferences in the past and often wondered what could make attending such conferences a more fruitful experience for everyone. I often hear participants complaining about things such as having to push away personal commitments, the cost of conference tickets, having to spend both time and money to travel all the way down to the event venue, having to spend many unproductive hours waiting for the next presentation that appeal to them, or having to make the hard decisions of choosing one breakout session over another that is happening concurrently. With all these issues that I've identified, I thought to myself, what if I can organize events in a manner that allow me to attract top trading experts from around the world to share their trading wisdom, as well as inviting aspiring global traders like yourself to come by and learn, both from the comfort of your homes. And with this, bring the entire trading community together to promote a healthy environment of learning the right values of trading so that everyone can become the most proficient and profitable trader he can possibly become. And this was how the Online Trading Summit was born. Once I decided to push ahead with the plan to organize this online virtual summit, I took special care to curate and invite only those reputable and influential trading experts who have proven their capability to impart their trading knowledge effectively. Despite this being the first summit of its kind in the region and us having no prior track records for holding a virtual conference, more than 30 prominent speakers accepted my invitation to speak in this summit. As such, I would like to take this opportunity to thank all the speakers for taking a chance on me and my team at TraderWave. I also like to thank IG Asia for sponsoring the summit and our official media partners, CMT Association, Stock EDA and Talking Trading for helping to publicize the summit to their audiences. Enough said, while I'm fully capable of dabbling on to share more about my experiences organizing this summit, I think I'll leave that for another occasion. The main reason why you are here watching this video is because you are hungry to succeed and eager to learn. To learn about the trading best practices, trading strategies, trading workflows, and whatever is required to help you progress on your trading journey. As the organizer and host of the summit, I have the privilege to kickstart your learning journey with a topic that I feel is one of the most important yet often underrepresented in many learning materials, and that is the science behind a profitable trading system. When we talk about trading, we often discuss issues like trading psychology, trading strategies, risk management, systematic trading, discretionary trading, and more. But at the end of the day, what outcome do all these principles of trading translate into? A scientific and quantifiable way of measuring your trading success over time. In this upcoming presentation, I'll share with you what an equity curve is and why an equity curve is the ultimate trading report card for your trading journey. Like what the theme of the summit says about helping traders navigate the journey from self-destruction to personal mastery, once you understand the science behind a profitable trading system, you'll be able to review your progress and know whether you are on the path towards self-destruction or on your way towards personal mastery. I hope you enjoy this presentation as well as the rest of the summit. Hi everyone, thanks for watching my presentation and video. Like what I do with all the other speakers in this summit, I usually get them to share a bit about their background. And as such, before I start today's presentation, I will also share a bit about my background with you, especially considering the fact that many of you might not know who I am. So again, my name is Philip, and I'm the host and organizer for this online trading summit. A bit about my background in trading. How did I get started? I actually started to know about the financial markets when I was still an undergraduate studying a mechanical engineering degree in Nyang Technological University of Singapore. At a point in time, there was this elective module where one of the lecturers shared with us about financial planning, and he said that if you want to retire early, you need to learn how to invest your money. And that was how it triggered my interest in the financial markets. And I started to self-study about financial markets like the stock markets. And as most of you would know, anyone who starts learning about stock market will always come across this person who is Warren Buffett. And obviously, at a point in time when I started to get to know the stock market, I became a very passionate learner of his methodology, which is value investing and fundamental analysis. And I studied all the while on that. And I bought his books. I read up on value investing. I even read Benjamin Graham's books on fundamentals and value investing as well. And subsequently, after I graduated, I really wanted to work in the financial institutes to continue to hone my skills of doing fundamental analysis. So, but as you know, I graduated with a very mediocre graduate degree. And as such, it was really difficult to get an opportunity to work in financial institutes, because most of the time they are looking for top grades, top universities, and things like a business and accountancy degree. And so I had to find a way to go inside financial institutes. And there was this opportunity when there was opening for a trainee dealer program. And I applied for it. I was selected, and I went through a 6-month vigorous training with regards to the stockbroking industry and learning how to deal and trade the stock market. So towards the end of that 6 months program, interestingly, I was actually asked and invited by the HR manager. He said, "Philip, I think that during these 6 months of training, you have shown considerable ability to analyze the markets and to do very good, solid presentations on your thoughts about the market. So instead of becoming a broker or what we call a dealer, would you be keen to explore the opportunity of becoming an analyst instead?" So at that point in time when he told me that, I was like, oh my God, that was beyond my wildest dream, because that was exactly what I self-studied, and what I really wanted to do. So I was really happy, and I asked him, so share with me more about this job scope. And interestingly, the next moment he said, "Philip, this is for the job of a technical analyst." And immediately I was like, in my heart, I was like totally devastated, because you know, for most people, when you start with fundamentals, technical will be something that you despise. You say, "Oh no, it's not for me." For those who start with technicals, they will say, "Oh no, fundamentals not for me." So I actually belong to that first camp, and it was really a tough decision for me to make, whether to take up this role or not. But I thought to myself, hey, if I take up this position that the HR manager has offered me and become a technical analyst and get into the research team, maybe the time will come when one of my fundamental colleagues who leaves their role, I might be able to take over. So that was the kind of intention. Of course, I didn't tell the HR manager, and I said, if the boss of the research team doesn't mind me knowing nothing about technical analysis, which was the truth, I'll be happy to take up this position. And indeed, the boss didn't mind anything about me knowing nothing about technical analysis, and I got the job. So I went into the investment research firm as a technical analyst who knows nothing about technical analysis. And fortunately, my boss gave me 3 to 4 months time. She said, "Philip, I give you a few months time. Go and learn whatever you need to about technical analysis, about trading, and I want you to start producing technical ideas for our clients across the entire bank when you are ready." All right. And so that was that starting point in my life that I started to dive into the world of technical trading from being a very passionate fundamentalist. And interestingly, during that 3 months of learning phase, I literally got to empty my cup, everything I know about the fundamentals, just put them one side and just dive deep and straight into technical trading itself, in which I probably read, if I could remember, about 40 to 50 books on subjects related to technical analysis, trading, trading psychology, money management, risk management, everything that could possibly help me in doing my job well. And interestingly, I realized how important technical analysis was, because during that 3-4 months, other than reading those books, I spent the bulk of my day diving and screening and running through visually a few hundred charts every single day across the Singapore market, Hong Kong market, and US market. And I started to realize from those few months of being so deeply deep into the analysis part of it, I realized how important technical analysis is, especially considering the fact that I realized that prices move not just because of pure fundamentals, but could be all sorts of reasons as well. And I found that, and I discovered that technical analysis is one of the very few areas where you get a sense of how the entire market is thinking and behaving, regardless of with what kind of motivation they decide to buy and sell shares or the instruments. So I became a very devoted technician thereafter. And ironically, subsequently, I was actually given the opportunity to become a fundamental analyst, but I told my boss, no, I think this is where I want to be in going forward. And that was how I became a very technical guy from that point onwards. And so that was a bit about the history of my background. Subsequently, I left the bank. I came out and started TraderWave with the intention of building a highly scalable software technology that can potentially help millions of traders out there, rather than just doing something that will benefit the few thousands of clients in a bank that I was working in. And that was also one of the main reasons why I started this online trading summit, so that I can benefit a big number of traders out there, rather than just benefiting a few thousands of traders who are able to attend some offline conference and event. So that's a little bit about my background. And interestingly, unlike many of the summit speakers who said that they have lost their accounts multiple times before they became enlightened and became a profitable trader, I didn't really get to experience that. And one of the main reasons was because I firmly believe in learning from the mistakes of other people. So that's the reason why I do a lot of heavy reading in any kind of trading books I can get, especially the series of market wizard books, which was really helpful. So in a way, when I started my real trading, I was very risk adverse. I understand about things like money management, risk management, and I didn't risk a lot in my trading. So I didn't really get a chance to lose my entire capital base. And that was really my journey, how I got started. And that's the reason why I wanted to focus my topic today on this part of a trading journey, which is not really commonly documented and widely shared about, which is the science behind a profitable trading system. So I'm going to go into my presentation slides right now and explain to you why is this particular aspect of a trading system so important for anyone to know, regardless what kind of strategy you are using and regardless what kind of psychology, what kind of stage as a trader you are. All right, so I'm going into the presentation mode right now. All right, so today my topic is going to be the science behind a profitable trading system. Now, this is the part where I think it is something not so artistic, not so ambiguous, but it's really some science and quantifiable factors behind a profitable trading system. But of course, before I can share with you what is the profitable trading system, I got to share this part about equity curve with you first, because I'm not sure how many of you actually understand and know this, is that equity curve is actually ultimately the trading report card for yourself. So if you are a proficient and profitable trader in a way, you should be seeing a very positive equity curve over the long run. So let me just go in and explain to you what equity curve is, and I will go on to share with you the different kind of equity curve for a trader at different stage of his life. So let's talk about the concept of equity curve. Essentially, to put it very simply, an equity curve is a plot of how a trading account's asset value varies over time. So let's say, for example, if you have a trading account, you have $10,000 in it, and let's say out of this $10,000, you bought $5,000 of shares. So your equity value is actually the value of your $5,000 that is left unused plus the open value of your assets of your open positions, which at that point in time when you first buy was about 5,000, which ends up being 10,000. So as your open trades, the value of your open trade changes, obviously your equity will change as well, right? So equity curve is plotting this amount of asset you have inside your trading account against time, all right? So generally, when we talk about equity curve, if you are a proficient and profitable trader, you should generally have an equity curve that slopes upwards towards the right-hand side over the long run, especially. So, and if you are, on the other hand, and unprofitable and not proficient yet, you tend to see your equity curve sloping down towards the right-hand side over the long run. But of course, there are occasions where you could be unproficient and profitable, and you could still see equity curve going up to the right-hand side, but usually that would not be over the long run, it will be over the short run. So you've got to be really careful about studying your equity curve, right? So, so this is how a chart of a general profitable trader's equity curve looks like. So as you can see, from 100 is the value that, let's say we, for example, for explanation purpose, $100 is the amount of equity you start with. So as time goes by over the months, your equity moves up and down, and by the end of the 12th month, you end at about maybe 119 level. So which means that your per annum returns over this particular 1 year amounts to about 19% gain. So that's the per annum returns. So now, next important concept I'm going to share with you is something called equity drawdown. All right. So equity drawdown is something really, really important for everyone to know besides knowing what equity curve is. So a drawdown is a period when your equity curve experience a peak to trough. That means from a top to bottom decline, measure from the highest point that your equity has ever reached. All right. To the lowest points thereafter. From after the highest point reached, it went down to the lowest point before it goes back up again to that last highest point and overtake it. All right, so that entire period is what we call a drawdown. So from a graphical chart perspective, let's take a look. So this is an example of a drawdown. All right, so the area where that green box highlights was the period when, after reaching a high of about 111 to 12, that's the peak, where the peak is, you actually see your equity heading down lower back to about 103, 104 region before it comes back to the original high again and overcoming it. So this entire period is what we call a drawdown. Now, drawdown is really important. Why? Why would I say that? Because during drawdown, and this is the part where most traders feels pain. All right. So other than the pain of individual losing trades and such, there is also another even bigger pain, which is the pain of drawdown. Now, generally, I think there's two types of pains that anyone will experience during a drawdown. One is the magnitude of a drawdown, which is the degree of pain experienced by a trader between that highest point you reach and the subsequent low before you goes back to that original high again, assuming if you even ever get to the last high again. So that's the magnitude of the drawdown. And another one is the duration of a drawdown, which means the period of time, the length of time experienced by a trader between the last highest peak reach to the next highest peak reach. All right. So let's take a look from this perspective. So as you can see over here, this was the same chart that I showed you earlier on. Now, this is the part where we are talking about the magnitude of drawdown, coming back from 112 back to 105. So that is the kind of pain that affects people differently compared to the duration of drawdown. So duration is the length which you spend getting trapped in an area before you go on to a new high. All right, so we need to understand and differentiate these two different types of drawdown because different people feel different pains when faced with such drawdowns. Some traders actually experience more pain dealing with a huge pullback in terms of the magnitude, all right, compared to the duration. So, I mean, for example, if I have to face a drawdown of, let's say, 15%, it's going to be painful for me. But if I just have a drawdown of 5%, and this drawdown took me, let's say, a long time, 6 months or even 1 year, I'm actually generally okay, fine with it. So I don't feel the pain of the duration, but I feel the pain of the magnitude. All right, but for another trader, the duration could be very painful, even though the magnitude is not very high. Let's say, for example, I can't deal with the duration. I cannot deal with the duration of the drawdown being too long. If the duration of the drawdown is too long, I feel very painful. But I'm able to accept if the magnitude of my drawdown could be very significant, maybe up to 20%, up to 30% of drawdown. I don't mind. I don't worry about it because I know it will go back to my starting point and then go even higher again. So some people are affected by either one. So this is something that we need to understand better about equity curve before we talk about what kind of equity curve is generally realistic for any trader and the kind of equity curve we should be looking out for. All right. So let's take a look at this particular equity curve. So this is an equity curve that goes straight from 100, okay, in a line that goes all the way to about 140, which means over this entire year, 40% returns has been generated without any kind of pullbacks at all. So, which means that there was no drawdown at all. This trader simply makes money on every single trade. So now, how realistic is this kind of equity curve? Frankly, if you ask me, I think that this is probably the equity curve of a dreamer or a god, because I have not seen anyone having that kind of equity curve without any kind of losing trades or having drawdowns at all, even in the open positions. Now, let's take a look at another equity curve. So this is an equity curve that generally slopes down from 100 original amount to about 50% level. So what are the typical traders that tends to experience this kind of equity curve over 1 year, over 2 years, or maybe even over the long run? Yes, typically those traders or investors even who doesn't really know what they are doing and they just blindly buy and hold, and whenever they have any profits, small profits, they quickly take it, and whenever they have any losses, paper losses, they tend to just hold back from selling it without cutting any loss. So, and that's the result of the kind of equity curve you could potentially see if you fall into that kind of category. Now, next, this is an equity curve of from 100, you throughout the whole year, the value of the equity actually moves from 100 to about 109 and then back to about 100 again, and then it floats there and then it goes down negative before coming back to 100 again. So generally, what's the profile of traders? What kind of traders actually have this kind of equity curve? Well, frankly, if you ask me, I think this kind of equity curve is pretty realistic, especially for new traders who are still learning the art of trading. And actually, frankly, if you ask me personally, for a first-year trader, I think this is actually a pretty good kind of equity curve to have, because with this kind of equity curve, you can clearly see that the trader is actually practicing, is executing trades, is getting trades done well, but sometimes losing, sometimes winning. At the end of the year, he is actually break even. But the important thing is to notice and to note is that this trader actually has managed to keep and protect his capital throughout the whole year despite taking trades here and there, which means that he must be doing something right in terms of being able to cut his losses. Otherwise, he will be seeing this kind of equity curve coming along. All right. So finally, let me show you one equity curve, and I think that this is probably the most realistic equity curve for any traders who are already proficient and generally profitable. So in this case, you see, for example, you start at 100, you fluctuate up and down, there's drawdowns, you have losing trades, you have losing streaks, you have winning trades, you have winning streaks. And by the end of the year, you reach somewhere between 10 to 20%. So this is generally a pretty profitable trader. But obviously, if you are a top trader and you have very good risk management and money management rules to follow, so your returns could generally swing as well from 20%, maybe even up to 40%, especially if you are shorter term, a profitable shorter term trader. So this varies, but generally a proficient and a profitable trader should see this kind of equity curve, not just 1 year, but actually over the long run. So next, I want to touch on a very important aspect before I can share with you the 6 key factors of a profitable trading system. I need to share with you this part about trading, which is important, which is what we call the risk management and position sizing, because without understanding this is very hard for me to explain to you the concept thereafter. So what is trading risk management? Very easy. This quote from Larry Hyde, a legendary trader. So he said this before: I have 2 basic rules about winning in trading as well as in life. If you don't bet, you can't win. If you lose all your chips, you can't bet. So it seems very philosophical, but actually it's pretty easy to understand, because the reality about financial markets, and even let's say in doing business, for example, if you don't bet, if you just hold on to your capital base and just leave it as it is, you can't possibly start a trade or even make money in any trades, right? So you got to bet. In order to bet, then you have to take risks. And you take risks, then you can potentially generate returns. And of course, you could potentially generate loss as well. But the important thing to understand is thereafter, the second point. If you need to bet in order to win, the important thing is when you bet, you must always try to protect yourself so that you will not ever come to a point where you could potentially lose all your chips. Because once you lose all your chips, you can't bet. But of course, you're going to tell me, yeah, no problem, right? I lose my accounts once, I just top up my account. But that's not the point, because if you lose all your chips, basically you have done everything wrong. All right. And if you keep on doing this, you're just going to keep on losing your chips. So the important thing about risk management in trading is this: you have to bet, but bet in a way that you don't end up losing your chips, so that by the time you become proficient and profitable, you have a chance to make the money back. All right. So why is risk management so important? Let's take a look. If you have $100 total capital and lost $60 or 60% of that, do you realize how much you need to make to break even again? Yes, this is as much as you need. Now, if you have a total of 100 total capital and you lost $80 or 80% of that, do you realize you need to make 400% just to break even again? And that is really a difficult way to climb out of a hole that you have digged for yourself. So this is the chart that you might have seen before, you might not have, but this is basically the risk of ruin chart, which tries to illustrate to you is that when you lose more and more of your capital, it is going to be harder and harder for you to break even or go back to recover your loss again. So which means that end up, if you lose up 100%, you'll be totally broke and you have no chance to even recover back to your original amount. All right, so which brings me to my point next. So in order for you to make a bet and not have a chance of losing so much, it means that there must be some tricks and mathematical formula behind to how you can actually go about navigating this, right? And this is the part which is really important about position sizing. All right, so position sizing is not a concept that I came up with. In fact, it was, I believe it was came up by Dr. Ventab, who happens to be one of the speakers for our summit. So make sure you tune in to his sharing about his thoughts about trading. So position sizing was something that really is important. So if you speak to any proficient and profitable trader, they will most probably know about it, the position sizings and how to go about doing it. So I'm going to share with you right now how to go about doing that. So before I explain to you how it works, just go along with me on the flow first. I'm going to just give you directives and just follow first, all right? So basically in the world of position sizing and risk management, one criteria is do not risk more than 1% of your capital on any stock. Okay, so 1%, just take it as a guideline for now. For new traders, in fact, or you're just starting off, I would suggest even going lower, 0.5%. What this means is that if, let's say, you decide to open a trade, and after buying a certain amount of shares, for example, in this particular trade, if you hit your stop loss and you get out of the trade, that trade should not have lost you more than 1% of your entire equity, the total value of your equity, right? Okay, so I'm going to show you the calculation later on, but just go along with me on the flow of this first. So with this, before you actually enter a trade, the usual practice is you should first determine your stop loss level first. So I'm not going to dwell on how you actually find the right place to put your stop loss. So we'll leave this to other speakers or maybe in other future presentations to talk more about that. But we have to assume that if you get into a trade, you might be wrong. So you need to set a stop loss level so that if the price falls to that stop loss level, it means that most probably your idea is not going to work out and you need to cut and exit the trade and cut your loss at that level, all right? So you determine your stop loss level first, even before you enter a trade, all right? So generally, you estimate your entry level as well, because you need to estimate first before you can actually do a calculation of how many shares or how many units to buy, all right? So what happens is you use the difference between the entry and the stop loss level to calculate the number of shares to buy in this particular trade that you're going to do. And if you do this, you execute the trade, and if you stick to your stop loss order or execution, you will not risk or lose more than 1% of your total equity in any trade if you are wrong. All right, so let's take a look at how to get this done from example perspective. So let's assume that you have $100,000 capital base, all right, to start with. And this is going to be your first trade, all right? So in this very first trade that you have identified, okay, so this, you say that, okay, this trade I'm going to take right now because it looks great, high probability, and to go to the kind of profit target that I'm looking for. So based on the rule that I shared with you early on, you are only supposed and allowed to risk 1% of your total capital or total equity. In this case, it's 100,000. So you are only allowed to risk $1,000 on any trade. So in this first trade, you're only allowed to risk $1,000. So if let's say your entry level for this trade happens to be at $1 and you determine your stop loss to be 90 cents, the difference between these two levels is going to be 10 cents. And as such, you use this $1,000 value at risk to divide by the difference between your entry and your stop loss. That amounts to 10,000 shares. So I'm going to just, for those of you who might still be confused at this point in time, let me just reverse engineer it for you. So imagine this. If you buy 10,000 shares at $1, how much do you have to pay? You got to pay $10,000, right, just to buy those 10,000 shares. Now, if you, after buying these 10,000 shares at $1, the price didn't move up to your profit target. Instead, it drops and hit your stop loss. And you diligently, as what I would advise, get out at your stop loss level of 90 cents. How much would you have taken back in terms of absolute monetary value? You would have gotten back $9,000, right? So you see, you put in $10,000 and then you receive back $9,000. So you only lost a total of $1,000, which is equivalent to 1% of your entire capital base or entire equity. All right. So this is the recommended way to actually size your trade, okay, regardless whatever trade you are doing. But in order to do this, obviously, you need to have an entry level, you need to have a stop loss level. Right, so I strongly encourage you to follow this model and this way or methodology of sizing your trade so that you will know how much risk you are taking for each of your individual trade and across your entire portfolio at any point in time, okay? So this is a typical way. You can usually use a position size calculator to do that. You can use a spreadsheet or you can use a calculator if you know how to actually go about doing this, which is really pretty easy. So in this way, you can very quickly decide and size up what's the number of shares or number of units you can buy for any particular trade, while always risking that 0.5 to 1% of your total equity. So this is one point. Before I go into the 6 key factors, I want to share with you. A stock is risky only if you did not place a stop loss to limit your risk. So if you take care of your risk and let the market take care of your rewards, that's the important element of it. All right, so a few things I need to share with you about, recommend for you is that the equity amount that you use to size your trade should be based on generally your current net equity, which is basically the amount of cash you have in your trading account plus the market value of your open positions at any point in time. So that is the actual equity amount or equity value at any point in time for you to size your trades on. And for novice or new traders starting off to learn the art and the science of trading, I would suggest you keep your percentage risk between 0.5 to 1% or maybe even lower. All right, for experienced traders, risk can be increased depending on your system's R multiples profile, which I will share very quickly later on. If you can't deal with a huge drawdown, or if you, like when I show you the equity curve earlier on and the pain of the drawdown, if you can't deal with huge drawdown, then I would suggest you to lower your percentage risk taken for each trade. In fact, the way to control the drawdowns, the magnitude of the drawdown is actually this part, which is your percentage risk taken. All right, I'll show you more examples later on. So now I'm going to move on to the 6 key factors to a profitable trading system. So firstly, reliability. Again, these 6 key factors, most of them actually came from Dr. Van Tap's teaching, and I'm just trying to translate them into very easy to understand format so that within just 1 hour, you can try to understand as much as possible what this all means, all right? So first key factors is actually reliability, which means that how many % of your trades are right. And the next important factor is R multiples. I will share with you more about that later on, and that is with regards to the relative size of your profits compared to your losses. Next, trading opportunities, very important. How often you trade determines what kind of returns you generate as well. and trading capital, how much cash you have allocated to trade. And this is pretty straightforward. And as position sizing, I'll just share with you earlier on. And that's the reason why I said you need to understand position sizing before I can explain to you the 6 key factors to a profitable trading system. And finally, cost of trading. How much fees do you actually incur on a round trip? So all this adds up to whether you are having a profitable trading system or not. And that's, of course, putting aside even whether you have the right trading psychology, whether you have a right trading strategy with an edge, because all these will factor into all these 6 elements itself. So let's take a look. What is reliability? Reliability is basically the win to lose ratio. A common name for it is win to lose ratio. So let's just take a look at this example of across 10 trades between trader 1 and trader 2. So trader 1, and just by looking at his profile, you see that 7 trades out of 10 trades were actually winning trades, which means trades that made him money, and 3 trades lost him money. All right. While for trader 2, 7 trades losing trades and 3 winning trades. And as such, as we can see over here, reliability for trader 1 is actually 70%, while reliability for trader 2 is 30%. Now, you might be wondering, so do you think trader 1 actually lose money out net? Does the trader 1 lose money or make money compared to trader 2? Now you realize, right, this number doesn't tell you anything about profitability at all, because this is just one part of the element. So now let's take a look at what's the other element that is really crucial as well in terms of whether a trader has made, or trader 1 or trader 2 has made money out of that total of 10 trades. Next is the R multiples. So this was a concept that was conceptualized by Dr. Van Tapp, and it became very popular and is a form of best practices thereafter. So I really want you to focus on this really well. All right, so R multiples is basically reward to risk ratio. So just go along with me again, just like position sizing. I'm going to define some of the terms to you, then I'll explain to you the rationale why. So R, let's just take it as initial risk. Okay, initial risk basically is the value between your entry level and your stop loss level. That's what we call the initial risk, and we just put a label R to it. All right. So if let's say if you got into a trade and you exited at your stop loss level, that is equivalent to a 1R loss. Okay, because R is your initial risk, right? The level between your entry level and your stop loss level. So if you exit at stop loss, you had a 1R loss. But if you exit, okay, with a profit that is 3 times the initial risk that you took, then your returns will actually be a 3R. So going forward, instead of looking at your the amount of absolute returns you make, or the percentage gain your particular stock has generated for you during your trade, all this doesn't matter. I want you to start looking and analyzing your trades from an R multiples perspective, because this is the only way to very reliably look at your trading system to see whether it's profitable for you or is actually losing for you. So now let's take a look at this particular example. So I'm not going to debate the rationale of the trade entry here, because that is not the point here. I just want to explain to you what happens and what happens to your R multiples as if based on the decisions that you might make, okay, according to this particular trade. So let's say, for example, as you can see here, there's a key resistance happening about the 220 region. And when it broke out, so let's say we decide to get into this purely based on a breakout strategy. So if let's say we decide to go long at 220, all right, and based on our own analysis, we decide that if the price, instead of going higher to our profit target, let's say it drops, if it drops to 210, it means that most likely we are wrong, because by the time it drops to 210, you will have to break the horizontal support as well as the uptrend support. So if let's say the price dropped to 210, we are wrong and we get out at the stop loss. All right. And let's say if we are right, it will keep on going higher and higher. And let's say if we deploy a trailing stop, we probably would get out at about 340 region. All right, so just based on this trade characteristic alone of this particular trade, we can see that actually with our stop loss placed at 210, our risk, initial risk, which is 1R, is equivalent to 10 cents. All right, and if we exit at 340, our reward between, which is the point between the entry level and the exit level, is about 120, which is equivalent to 12R of the initial risk that we actually adopted. All right, so this was a trade that had a 12R returns, okay? 12R with respect to the initial risk that you have taken. Now, some traders might think, oh, this stop loss seems too close. I don't want to put it so close because I don't want to get whipsaw. So I'm okay with making less profits, but I want to have a bigger, wider stop loss. So another trader could potentially, instead of deciding to put a stop loss at 210, for one reason or another, he could decide to put the stop loss at 190. So what happens? What changes right now in this particular scenario? Entry level hasn't changed. Profit exit hasn't changed, but stop loss exit has changed right now. All right. So with this perspective, if a trader set his stop loss at about 190, his initial risk exposure, instead of being 10 cents, now will become 30 cents instead, because we are talking about 220 to 190. So if the initial risk is 30 cents, so 1R right now becomes 30 cents. So even if you get out at the same exit level, which is 340, do you realize now that your reward or your returns has now become just a 4R multiples compared to your initial risk? All right, so that's, now you might have started to realize, oh, so I see there's this particular difference over here. Now, so that's the reason why it's actually important to understand what is the stop loss level that you have set. Which brings me to my point over here, is that I personally believe that in trading, any kind of decisions you make, there is no one single best decisions. Every decision that you make has got its pros and cons. So in this case, the pros of setting your stop loss very close to entry price is that if you manage to hit your profit target before it touches your stop loss, you will get a very high R multiples. All right. So the closer you place your stop loss to your entry level, obviously the downside is the more likely you will get stop out, right? Because of whipsaw. All right. But at the same time, for those trades that you don't get stop out with a very tight stop loss, you will end up with winners of higher R multiples. All right. So imagine this. So R is initial risk. Imagine if we just risk 1%. Okay, as an initial risk, as what I shared with you in the position sizing earlier on. So 12R returns will be equivalent to 12 times 1%, which is a 12% return on your capital. All right, and a 4R returns will be a 4% returns on your trading capital. So I hope you're starting to understand the relations between all these things. And so as such, if you take a look at the R multiples between trader 1 and trader 2, so imagine this. If you diligently try to measure every single one of your trade based on R multiples, by the time you finish 10 trades, you will probably have a series of R multiples that you have documented down. So in this case, let's take a look at between trader 1 and trader 2, as assuming that they have documented down their R multiples return profile of across 10 trades. All right. So as you can see in trader 1, do you realize that for most of the trades that was making money for him, it was always about 0.5R, 1R, 1.5R. Which means that every time he exits a profitable trade, he makes only about 0.5 to 1.5 times the initial risk that he took. And interestingly, if you take a look at trade 4, he actually had a minus 9R. How could that be? I mean, if someone decides to set an initial stop loss at a certain level, if you get out at the stop loss, it would only be a minus 1R. How could it ever be a minus 9R? So this is the interesting part, because the reality is when a trader, assuming even if a trader sets a stop loss, sometimes traders set a stop loss, they might not execute at the stop loss because of psychological issues, because of emotions coming into the picture. So they violated their principle and their rules of getting out at the stop loss level. So they didn't take their stop loss, the price continued to fall. And finally, when they gave up, they decided to exit the trade at a much, much, much lower price. And that is how you can end up with a loss with such high R multiples. So technically, if you set your stop loss and you stick to it, every of your losing trades should evolve around a minus 1R. Okay, and you see, as you can see below on the trade 9, there's a minus 0.5R. So how could a trader have actually a minus 0.5R? A lot of different factors. It could be a trader decide to get out of the trade before the price touches the stop loss level for one reason or another. So again, it all depends on whether he actually got out early because he violated the rule because of emotion or psychological reason, or whether he has a valid reason to do so. So that differentiates whether getting out at a 0.5R is actually a good trade or a bad trade. Now, if you take a look at trader 2, what happens is that you will notice that despite having 30% reliability rate, percentage, which means 7 trades were losing money, all the losing trades all evolve around 0.5 R to about 1 to 1.5 R loss. All right. But for the 3 trades that make him money, he actually generate 3R returns, 5R returns, and 4R returns, which means that a net R multiples between trader 1 and trader 2 ends up trader 1 actually lost money, having a minus 3.5 R despite having a 70% reliability percentage, while trader 2 generate 5R return across 10 trades despite having only 30% winning ratio. All right. So next thing I want to introduce you is this expectancy. Okay, expectancy, very easy. Expectancy is the net R multiples divided by the total number of closed trades, the trades that you have closed. So if you look back at trader 1 and trader 2 over a total of 10 trades, This was the net R multiples that you see in the previous slide, minus 3.5 and plus 5. So a total of 10 trades were done. So which means that expectancy for trader 1's system is actually 3.5 divided by 10 trades is minus 0.35 R. While for trader 2 is positive 0.5 R. So why do we want to actually calculate this expectancy number then? So now imagine this. If you have done, let's say 30 trades, maybe 50 trades, and you have been tracking your R multiples across all these different trades, you could probably arrive at an expectancy number across that 30 to 50 trades. And if let's say you have an expectancy number of minus 0.35 R, you could technically expect that over the long run, on average, per trade is going to generate you a minus 0.35 R negative returns. All right, and this is definitely a losing system, because if you're going to risk 1% in a minus 0.35 R on every trade, that's the amount that you're going to lose. So can you imagine this? If you have a negative expectancy and you have your risking from 1% to 2% to 3% to 5%, you are going to lose more and more money in this manner. But if you have a system that has a positive expectancy over a large number of trades, you could generally assume that if nothing else changes, over the next 100 trades, you should expect an average return of about 0.5 R for trader 2 over the long run per trade basis. All right, so when you understand your expectancy number, then you could potentially plot your expectancy number over time. And if your expectancy number always fluctuates at the positive range, it means that you are having a profitable trading system. And how does a proficient and profitable trader become a really top and highly profitable trader? Usually you will see an expectancy of a highly or top trader going up over time to a very high level and hold at that level without coming down. All right, so I hope you get an understanding of expectancy over here. So Dr. Bangtap, he said, shared this before. In fact, he talked about it during my interview with him as well. To get a good idea of your system's expectancy, you need to have a minimum of 30 trades to analyze. And in order to really get a clear picture of your system's expectancy, you should actually have somewhere between 100 to 200 trades completed, right? So next thing I'm going to touch on, the other key elements of a profitable trading system is, of course, the cost of trading. Because ultimately, like any other business, your net returns in your trading equals to your total returns minus the cost of trading, all right? So if you factor in the cost of trading, including commissions, interest paid for every single trade, your net R multiples is going to be lower if you factor it into your R multiples calculation as well. And so your expectancy will be lower as well. So if you think about it from a very logical perspective, the more you lower your average cost of trading, the higher your net R multiples and the higher your expectancy is going to be. So that's like common sense, right? Now let's take a look at this, a few scenarios I want to show you so that you can understand the different perspective. So let's take a look at between two different systems or two different traders right now. All right. So let's say that other than a trading system expectancy, which is different between the two systems or the two traders, one is 0.5 R and one is 2 R. And obviously, most likely they have already generated a significant number of trades to come up with this expectancy number. So assuming that the only difference here is the expectancy number, but everything else remains the same. Number of trades in a year, same 10. Trading capital, same 100,000. Risk in every trade, 1%, same. All right. So if you take a look at this case, you will realize that for the first system, projected return will end up to be about 5,000, which is 5% per annum. How do we actually calculate it? Remember, 0.5 R. What is R? R is your risk, right? Initial risk, which is in this case the 1%. So you put the 1% into the R, you have a 0.5% times 10 trades. That's about 5% per year returns. All right, so that's the reason why you generate 5% per annum. So 5% of $100,000 capital, that's a $5,000 absolute return per annum. Now, if you have a 2R positive returns in terms of your system expectancy, this is the kind of projected return you're going to get, 20% per annum, which amounts to about $20,000. All right, so as you can see here, everything else remains the same. A higher expectancy system provides you both a higher absolute returns as well as a higher percentage return. All right. Now let's take a look at trading opportunities. Now, if let's say your system expectancy remains the same for both systems, but the number of trades that you can generate in a year is 10 versus the other one, which is 100. Now we got to assume, I'm putting in some assumptions here. I'm assuming that regardless whether you do 10 trades a year or do 100 trades a year, both these systems has the same system expectancy. All right, but naturally, if you do 100 trades a year, the expectancy might not be exactly the same compared to if you just do 10 trades a year. So this is just a generalization, but I want you to understand the math behind this entire thing. So if you take a look, your projected returns will end up to be 5%, which is 5,000 per annum if you generate only 10 trades per year based on this expectancy, this trading capital, and this amount of risk in every trade. While if you can maintain your expectancy at the same level as 0.5 and you are able to generate more trades in a year, end up you will have 10 times more, which is in this case 50% per annum return or 50,000 absolute returns if you can generate 10 times more the trade without making your expectancy deteriorate. All right, so that's the reason why you might have heard about before that for short-term traders, it's actually possible to generate both higher absolute returns and higher absolute returns with the same capital base, because for short-term traders, you generate more trades in a year. All right, but that is with the assumption that expectancy of a short-term trader doesn't deteriorate compared to a longer-term trader or even an investor kind of profile. Right, so trading capital is the next important thing. So if let's say everything else remains the same, but trading capital varies, 100,000 versus 10,000, you will realize that your percentage returns remains the same for both system or for both traders. The only difference is your absolute returns will vary, which means that trading capitals varies only your absolute return, but it doesn't change your percentage returns on a per annum basis. All right, and finally, position sizing, which is really, really important. If everything else remains the same and the risk in every trade varies, this is what's the outcome going to be based on a 1% risk per trade. In this case, you generate 5% per annum returns, which is $5,000. And your projected returns, if you risk 5% in every trade, will end up to be 25% and $25,000 absolute returns. So it brings us to a point over here. If you have a positive R in your system, it actually does make sense to risk more in every trade, right? Yes, in a way, yes. But there's some other elements which you need to take into factor as well, and not just as simple as having a positive expectancy system. You can just risk 50% or 100% on your trade, because you could potentially have losing trades. You could have losing streaks where if you risk too much in every trade, you could end up losing everything first before you have a chance to reach that positive expectancy again over the long run. All right, so I'm going to show you an example over here, which is equity curve simulation. So it's spreadsheet that I've prepared to show you how equity curve could vary depending on what kind of strategy you trade, what kind of profile you have, and the amount of risk that you take. So let's take a look. I'm going to show you right now. All right, so this is a working spreadsheet of an equity curve model. So let's, right now, as you can see over here, of course, I'm just using 10 trades so that it's easier to see, but usually, typically, you should actually try to generate 30 to 50 trades in order to have a reliable number. And as you can see, these are the R multiples profile that I've just put in here for the different types of trader. Again, I want to just have a disclaimer. This is just based on a generalization, all right? It's not to say that every swing trader will see this kind of profile, or a trend follower will definitely see this kind of profile. But based on my experiences, this is the general profile of R multiples profile of this particular type of strategy and trader. All right, so let's take a look at the profile firstly of a typical retail traders here. So I'm going to just paste over the value over here. So you see a typical retail trader who is not trained, who doesn't understand what he's doing, always take quick profits and let his losses run, will end up having this kind of equity curve. All right. So as you can see here, based on the R multiples profile, what happens? Losing trades, you have -3R, -5R, -4, even -11. But for winning trades, it's all about just 1R. So what does this show? It shows that this trader is constantly taking very quick profits, but letting his losses run. And imagine this, he is only looking at risking 1% initial risk based on this profile. And his equity has dropped from a starting 100 to about 85 or between 80 to 85, which is not so bad. So you can see over here, right? If you risk just 1%, even having this kind of negative R multiples profile, you still might not lose that much. But if we take a look and see, if you risk 5% instead of 1%, what's going to happen? Wow, by the end of 10 trades, your equity would have dropped to just slightly over $25, which is 25%. Okay, and this is going to be a huge hole for you to try to dig out. Okay, and that is the reason why I share with you the risk of ruin earlier on. All right, and if we take a look at risking 10% per trade, all right, the trader would have gone bust, okay, closed down and shut his account by the 7th trade, because by the 7th trade, he would have lost all his capital if he had risked 10% over here. All right. So now let's take a look at another profile, which is what I personally call it a dreamer profile. Why do I call it a dreamer profile? Because firstly, a dreamer profile has no losing trades. Every trade is winning trades. And at the same time, every winning trade is not just 1 R or 0 point something R, but high R multiples. So this is the kind of dream profile we are looking at. But well, let's pray that you will ever have this kind of profile, because you probably only get to dream about it in your dreams. And let's take a look at a loser profile. What is a loser profile? Basically, I'm just trying to exaggerate the different kind of profiles over here so that you can understand the implications over here, right? So a loser profile is obviously the opposite of dreamer profile, which means you have every trade being a losing trade, and most of your losing trades are having a high R multiples loss. All right, but obviously this is not going to be easy to achieve as well, because you've got to be really bad and really unlucky to even have this kind of R multiples profile. Now let's take a look at another profile, which is very interesting. Something that many of us never think about, because I understand that there is this train of thoughts about trading, is that I want to achieve a high reliability number. I want to achieve a high win to lose ratio of 80% and 90%, and I can do that. And it seems like I can be a very profitable trader if I can achieve that kind of win rate. All right, but I think that is just half the picture, because I want to show you this example to help you understand that high win to lose ratio or high winning ratio doesn't mean anything. All right, because when you are hit with a black swan event, you could still end up losing everything, especially if you have taken huge initial risk on all your trades. So let's take a look. Long-term Capital was actually a hedge fund that famous for going down despite managing billions of dollars. So what happened was that a team of PhDs from many of the Ivy League universities came up with a mathematical model algorithm that gives them a really, really high winning ratio, high reliability percentage in terms of the trades that they generate. But what happens is that every of their winning trades actually generates very little profit only. So they are banking on a high reliability number, but very low R multiples to make money out of it. So subsequently, what happens was that they were able to make a lot of money for a period of time by having all these very high reliability number and very low R multiples returns by leveraging, borrowing a lot of money and to bet big on all those trades. And what happened was that there was this black swan event when the Russia ruble actually collapsed and the fund ended up going bankrupt. All right, so, and this is the kind of R multiples we are generalization again, but this is typically the kind of R multiples profile we look at. So as you can see over here, for like 9 trades in a row, you keep on being profitable, but on the very last trade, which you didn't expect, you actually had a minus 30 R multiples kind of loss. So if you had just lost, risk just 1%, you will notice that it might not have been so bad. You only lose about 20% close to 30% of your total capital. But let's take a look. If you increase your initial risk to 5%, you would have lost everything by the 10th trade if you just increase your initial risk to 5%. And this is also an example I want you to understand about having losing streak, which brings me to my point next. This losing streak profile over here. So a losing streak profile for any strategy, no matter how robust your strategy is, there are periods of time you could potentially face losing streaks where you have 5 consecutive losing trades, or even 10 consecutive losing trades before your trades or your strategy starts to work out positively for you again. So imagine in this case, if you have a losing streak profile over here, and if you risk 1%, your capital will have gone down to about 90% before going back to 100 and even see positive gains by the end of the 10 trades. All right. But if you have a losing streaks and a profile and you risk 5% in every trade, do you realize what happened? Your equity actually goes down from 100 to about just under 60. And by the time of the 10th trade, you actually still is losing money instead of making money compared to if you risk 1%. Now, if you risk 10% in every trade, this is what's going to happen. By the end of the 10th trade, you are still at about 75%. All right. So have you started to see how initial risk could potentially affect the exact same R multiples profile of your trade, and considering the sequence of how things happens as well. Now, next profile is actually a scalper profile. A scalper is someone who gets in and gets out of the market very quickly making 1R, losing 1R, making 1R, losing 1R, but generally they try to have a positive reliability number. All right, and see, this is how the profile of a scalper looks like. And swing trader, okay, which most of us will fall under, is that for a swing trader's profile, usually is that if you are diligent enough and you are disciplined enough to stick to your initial loss, usually you will lose just about -1R for your losing trades. And for those winning trades, you will be looking to generate things like 2R and 3R returns. So even if you have a 50% reliability percentage, you could still have a positive R multiples and seeing an equity curve that is generally heading up in this perspective. Now, this is based on 1% risk. All right, so if we risk, let's say 5%, what's going to happen is you are going to see a higher absolute return by the end of the 10 trades. But at the same time, what do you notice is that your drawdown will be deeper as well. All right, so let's take a look at 10% and see what happens. Okay, so you will see that in this case, you will go up to a very higher, much higher return. But in terms of the value of your drawdown, it's going to be higher compared to if you risk lower as well. All right, so this is how everything comes into the picture to affect your equity curve and affect the kind of drawdown that you see. All right. And finally, trend follower. A trend follower's profile are typically what they do is that when they try to get into a trade, they have pretty tight stop loss. They want to get in and ride the long big trend out there, and they keep their stop loss pretty tight. So what happen often end up is that trend follower typically has more a stop loss being hit more often, but once they manage to capture a trend that just swings out and rides out as far as possible, they generate significant returns on those winning trades. So trend follower tends to have lower reliability percentage, but have very high R multiples return. And so this is the kind of equity curve you will see. All right, huge drawdown as well sometimes. All right, so I hope with me sharing with you this equity curve simulation, based on the different R multiples profile and based on how you vary your initial risk, you realize that there's a lot of different combination to what could potentially happen. All right, so I hope this can help you understand what are the essential things to focus on in terms of your trading. So now let me get back to the slides. Okay, so let me summarize again the 6 key factors to a good trading system. Firstly, reliability. How many % of your trades are right? R multiples, trading opportunities, trading capital, position sizing, and cost of trading. So you will realize by now how all these factors plays into how your equity curve will change over time. All right. So that's the reason why I would strongly encourage any trader who is serious about their skills and of trading to want to become a profitable trader. You need to journal down your trades. You need to write down and record down your trades, and also to track the R multiples of your individual trades. So as you can see over here, if you have been diligent about entering your trades and all those key elements like your stop loss entry and your exit, as well as the commission that you have paid, and maybe including dividends as well, if there's any, you will be able to compile the R multiples of your each individual trades in this manner. So you can see over here, 3.49 R multiples return, 1.01, why 0.01 is because of the commission that you paid. All right, so if you do this in a way, you will be able to analyze, okay, your closed trades to see whether you actually have a profitable trading system or you don't. And this is regardless of what kind of trading psychology, what kind of strategy you have, because ultimately, if you don't have a system with a positive number or a net R multiples return over a large number of trades, it doesn't matter what kind of psychology you have, what kind of strategy you have, you're just simply not making money. All right, so if you just take a look at quickly reviewing individual trades. So when you have a losing trade, always check the following. Do you follow your exact original plan? Do you exit exactly with a -1 R multiple? Because if you have been diligent in following your stop loss, you should have -1 R for all your losing trades. If it's more than a 1 R loss, what happened? All right, so there are circumstances where it could be within your control or it could be without your control. So for example, let's say you have a stop loss of 90 cents, but the next day the market gap down opens at 80 cents and you decided that I'm going to just cut it. So your R multiples could end up to be -2R instead of -1R. So that's something that is out of your control. And you basically that was still considered as a good trade because it's out of your control. But if let's say when it touches your stop loss and you decided not to get out, and instead you wait, and finally you gave up and get out at a -5R, that was something that is totally within your control, and you need to review why did that happen, because it shouldn't have happened. You didn't follow your rules, you didn't follow what you set out to do. All right. So was your stop loss too close to the entry point? If you keep on having -1R, -1R, -1R losses. All right. So it could be a case of your stop loss level being too close to your entry level. Now, even if it's a winning trade, doesn't mean that it is a good trade. All right. And the reason is this. Important thing you need to ask yourself is that if you have a winning trade, do you actually follow your exact original plan of getting out at a profit target or having your stop loss? How many R multiples do you exit with? If you exit with R multiples of only 1 to 2R, why was it so low? Was it deliberate? Was it part of your plan to exit with 1 to 2R? Or was it because you are very scary cat and you just wanted to get out with a profit, small profit first before it actually reaches your profit target? All right. So after that, once you have a long series of trades, you can actually review the entire series of trade to see what is the reliability of your system, how many winning trades versus losing trade, and ask yourself, why is your reliability so low? Okay, so if you have a reliability percentage of 10 to 20%, that is pretty low actually. But if you have about 30 to 40% reliability number, that's actually still pretty okay if you are having a high risk reward to risk ratio, which is your net R multiples. So your net R multiples, is it positive or negative, or why was it negative? And what's the profile of your R multiples across the entire string of trades? And what was your biggest losing streak like? So these are the things you need to know. And once you know all these, you can answer questions yourself and see what is the expectancy of your trading system, why is it negative, and finally, are the results of your trading system meeting your expectations based on your trading objective? So my recommendation for you with regards to this particular part of it is that be absolutely diligent and disciplined in recording your trades, because any trader that I see is not recording his trades will never become a proficient and profitable trader. Take my word for it. All right. I have never seen any trader who doesn't diligently track his trades become a profitable and proficient. So take my word for it. Make sure you track your trades and measure them and review them. And because this is the only way to fully utilize the science behind a profitable trading system to work in your favor over the long run. All right. So let me just summarize the steps that you need to take in order to help you make sure that you can take full advantage of the science behind a profitable trading system. Firstly, formulate your trading plan. How many percent to risk in every trade? How are you going to determine your stop loss? How are you going to determine your profit target level? So once you formulate your trading plan, you execute your plan in a very disciplined manner. So as long as nothing changes drastically, just follow the plan that you have set. And once you execute your plan, make sure you track and journal your trades diligently, all right? Because this is when you will have the opportunity to review your trades and identify any potential issues. It could be psychological issue, it could be a strategy issues, which is losing edge. But either way, you'll be able to know what is the main problem once you document and you journal down your trades based on the R multiples profiles that I've shared with you earlier on. And finally, after reviewing your trades, you need to ask yourself, is there a need for me to refine any of my parameters? Maybe should I move my stop loss further away? Maybe should I move my stop loss closer? Or maybe this entire system is not even profitable at all. So maybe I should change my entire system, but I wouldn't suggest you doing that until you have at least 30 to 50 trades before you think about overhauling your trading system, all right? And then rinse and repeat, really is just as simple as that. And of course, don't give up, all right? So for new traders, a lot of times I ask them, what is your expectations coming in as a new trader? What do you hope to achieve in your first year of trading? Many of them tell me, Philip, I'm looking to generate 10%, 20% returns. Well, usually I don't want to give them a wet blanket, but usually my suggestion to them is, for your first year, please focus on process, focus on your trading plan, focus on being diligent to track your plan, track your trades, review your trades, and don't think about the returns you generate in your first year. Because as what I shared right from the very start of this presentation, if by the end of the first year you have taken 30 trades, 50 trades, 100 trades, and you are still at break even, I actually would congratulate you, because you are already doing fantastically for a first year trader. So set your expectation low, but make your expectation high in terms of the way you follow your trading plan and your trading process. Start small, trade small, so that you can protect your capital when you are learning. Well, the fact about learning is that you don't really learn unless you do it. And to do it, you need to risk a little bit of money, because if you're not risking money, there is no psychological issues that you'll be facing. But once you start risking a little bit of money, psychological issues comes into the picture, and you need to train your psychology as well. So trade small, protect your capital when learning. Only focus on maximizing returns. That's where we talk about 10% return, 20%. Only start focusing on that part of it after you have learned how to protect your capital well, and you are able to diligently execute your plan and your strategy in a very consistent manner. All right, so I hope this presentation about the science behind a profitable trading system has been enlightening for many of you, for most of you, and will help you in your journey from here onwards. And if you would like to connect with me, this is how you can reach out to me. Feel free to connect with me on social media as well. And of course, TraderWave is the company that I run, and we provide a web-based charting application to help traders assess the markets easily from any internet device. All right, so I hope that this session has been beneficial for you, and it's really, really important. I want to just emphasize on this again. Regardless what kind of trading strategy, holy grail strategy that you think you might have, regardless what kind of trading psychology, risk management issues that you have, all this will all have to surface when you start to track your trades and use this way that I've just shared you to journal down your trades and to track them. So I wish you the very best in your trading journey, and I hope that you will continue to get a lot of insights and learning points from the rest of the speakers who's going to come after me to share their thoughts and their trading experience in the days ahead. So enjoy the summit and grow and become a better trader. Best of luck.